What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this evening. So what we're going to be covering in this update video is the newly released exchange reported short interest numbers on AMC and what they mean for what we have going forward in terms of how we're going to see these estimates that Ortex has been giving us change over the next couple of days. Now, in addition to this, we have seen something happen with AMC's option chain today that I don't think we have really ever seen before. This is happening on the January monthly expiration day, and this was previously, in my opinion, the most dangerous option chain that we have ever seen on AMC. Not necessarily because of the amount of contracts that were in the money and out of the money, but just because of the vast dollar amount of basically exposure that these market makers would have if we were to see this next massive price run up to the upside. The market makers have done something. I know a lot of people are speculating as to whether or not this was institutions or individuals exercising call options, but it doesn't appear that that's exactly what it is. Now, in addition to this, we also have to go over something that I've kind of found in the new quarterly derivatives report of the Office of the Comptroller of the Currency. There's a key distinction between OTC and exchange traded derivatives, and I want to make sure everybody really knows the implications of exactly what this means for our financial system going forward and what types of margin calls we have been seeing and what we are going to see in the future. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So looking at the price action for AMC today, well, we started off the day pretty weak. We ran up to $29.39 and then just kind of bled out for the rest of the day with some spurts of bullish momentum. But we closed the day up 0.63% at $28.70. And in the after hours, we're at $28.62. So solid day to start off the week. On a green day, we did see the S&P 500 hit all-time highs. So we could have ended up seeing a little bit more bullish momentum out of AMC today. But again, we have a long way ahead of us in terms of what we are trying to accomplish in every aspect of this investment. So coming over to the Ortex update right here, utilization 77.65%. The estimated short interest right now on AMC as a percentage of the free flow is sitting at 18.67%. Now, when we come down and take a look at the exchange reported short interest data for AMC, we can see here that the settlement date, December 15th, release date today, shares short 96 million, which is up from the last time, in the short percentage of the free flow, 18.84%. But what we have to key in on is what was Ortex estimating at this time period that AMC's estimated short interest was. When we come over to this chart right here and we take a look, well, on December 13th, the estimated short interest was 20%. And then a couple of days later, I believe on the 16th, we can see right here, or the 20th was 19.35%. So this exchange reported short interest number is coming in slightly lower. So I would not be surprised, and I don't think it's going to be any cause for concern if we see some of these estimates in terms of the short interest start to fall over the next couple of days. Again, guys, the shorts that we are looking at to cover have not covered. Now, let's get into the situation with the options chain on AMC because it is extremely interesting. And we talk about options a lot on this channel and how it relates to AMC, but let's take a look at this page right here. So we've been focusing on this January expiration date. What we can see is appearing now is only 74,000 call contracts in the money right here and only 262,000 call contracts out of the money. There's a key distinction here that I want everybody to fully understand. So the in the money calls, we're up to about 120,000 contracts in the money. So when you see that number drop, it could suggest the exercising of a lot of contracts. But if you were to see a lot of contracts get exercised, you wouldn't really see the out of the money call contracts drop as much either. So here is what is happening and why the market makers are so worried about what's going on in this option chain. And there's something else that we need to take a look at as well. So remember, the dollar amount that the institutions are exposed on this options chain is a bit higher. We know the implied volatility is a little bit higher. The options are a little bit pricier this time around when you compare us heading into January versus going into June. But what we see here is that when you think about what the market makers have to do, it is always more costly for them to hedge the contracts versus just buying them back to close the contract. When the market makers are selling these options, let's just think about it from a very basic perspective. The market makers are technically selling something that does not exist. They are selling a new contract. So their position right now is going to be -1. Now, in order for that to get to 0 in terms of decreasing that open interest, all they have to do is go out on the open market and buy that same contract that they sold back, basically shorting the call options, buying them back later, and closing it out, decreasing the open interest, which is exactly what we're seeing right here. Typically, what we see in terms of the gamma squeezes in the past that we've seen on AMC is that about 2 weeks before the expiration date happens, so in this case, we're about a week before, or 2 weeks before when we would expect to see the run-up, we see that run up on AMC 2 weeks before the expiration date. Now, 2 weeks before the 2 weeks is supposed to start, well, we're seeing the open interest significantly decrease. The other thing that we need to think about here is how these institutions hide, or how Kringle Kitten, shout out to Kringle Kitten, how he coins it is spoofing their short interest on the option chain. Remember, they can enter into those buy right trades where they sell those deep in the money calls and buy the quote unquote synthetic long shares from the market makers, essentially meeting their broker's closeout requirements, but not actually covering any short positions. And it is going to artificially suppress the short interest numbers that we see on the exchange reported short interest reports that we just took a look at. Now, when we come over to the January expiration date, we did end up seeing about a month ago some very weird trades come in at this $7 through $9 strike point. So the open interest on these contracts has significantly decreased. So what does that tell us? Well, they have rolled some of these contracts out in these essentially positions to hide short interest to further expiration dates. Previously, remember, we were saying that the institutions were going to have a decent amount of problems trying to guarantee the counterparty to these buy right trade transactions, because they need to make sure that the person who is buying these call contracts from them is the market maker. And that date was going to be July. And this was the only date that they were offering contracts under the $20 strike. But recently, they started to offer contracts all the way down to 10. You can see the open interest on these contracts right now is incredibly low. So what this is enabling some of these institutions to do is give them a better opportunity to kind of spread out these trades across a couple of different expiration dates and make it more difficult for us as retail investors to see which strikes they are piling up on to essentially hide the short interest that we are seeing on AMC. Now, before we go any further into the next thing that I want to talk about, I know this may seem like a bearish thing, that the gamma squeeze is kind of being stifled by some of these market makers because they are decreasing the open interest. In my view, it doesn't necessarily really work like that, because we all know what people like to do with these big monthly options expiration dates. A lot of people start to YOLO on calls. They buy a lot of these out of the money contracts in the hopes that they're going to run in the money. So it is still entirely possible that we see this in the money and out of the money call open interest that we see right here on Stonko Tracker significantly increase over the next couple of weeks. The other thing is that the fact that these market makers are doing this, buying to close these contracts to try to limit their risk, it means they're terrified of what we have coming up at this January expiration date. We saw it happen in January of 2021. We saw it happen in June, and they are trying to prepare themselves for the next run-up so they don't lose a substantial amount of money. But in my opinion, there's not a whole lot that they can do about it, because the way the market makers work is they have to sell you those contracts. If a lot of people want to buy these contracts, they have to sell them to you. So if we start to see a wave of people gambling on these options again, well, the open interest is going to get jacked up, and we are going to have another very dirty and nasty options chain going into that January expiration date. Now, the other thing and the last thing that I want to talk about is something that I found in this uncleared or this OTC derivative report that the Office of the Comptroller of the Currency puts out. Remember, we've talked about phase 5 UMR many times. There will be an upsurge in the volume of margin calls and the increase for in the need for third-party custodians to keep safe collateral surrounding these OTC derivative positions. That's the key part right here. A lot of these right here for over-the-counter derivatives. When we look at the quarterly derivatives report that we have gotten from the Office of the Comptroller of the Currency, it breaks it down in this chart right here, the percent of exchange-traded contracts versus the percent OTC contracts. We can see when we come down here that the vast majority of these derivatives are essentially over the counter. So there's going to be a lot of margin calls happening all the time. The other thing that I want people to fully understand, and I don't think everybody really grasps this yet, is that when we talk about margin calls, you can never really get a good understanding of who or when the margin calls are going out, because there's never going to be a notice that comes out that says such and such institution has received a margin call. And when we actually see the margin calls go out, well, that doesn't necessarily mean that we're going to see an increase in the price of AMC or any of these other stocks that are heavily shorted, or that these institutions are over leveraged on. To meet a margin call, all you have to do is add more liquidity into your accounts. The other thing that we have to think about here is who is really holding the risk on these derivatives. So when you think about these products, the banks are offering and advertising these products to their clients. So let's say it's a bullish product. Let's say it's some sort of currency swap or some sort of interest rate swap. You don't necessarily have to know what these products are in order to understand this example, but let's just say product A is being sold to investor A by, let's just say, the first person on this list, JP Morgan Chase. So when JP Morgan sells this product to investor A, JP Morgan essentially becomes short this product. The investor is long, JP Morgan is short. Now, JP Morgan, all of their traders are going to go out in the market and essentially figure out the proper hedge in order to make sure that the bank doesn't have any directional risk on this type of product that they are selling. But from what we've seen in the past with 2008 and what we saw in January and how that SEC report came out and said that there really was not a lot of hedging going on, it's unclear whether or not these institutions are actually hedging these positions. Now, when you combine that with a lot of these contracts being over the counter, well, there's a lot of exposure on the table here that if the market starts to freak out in one direction, or even if AMC and GameStop really start to take off, a lot of these institutions are going to be heavily at risk. So that is going to wrap up this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening, and I'll see you guys in the next one.